In this lesson, we're going to be looking at some principles of accounting and record keeping. Accounting principles are the general rules and guidelines that companies are required to follow when reporting all accounts and financial data. The first principle: record expenses and liabilities as soon as possible, but record revenues and assets only when you are sure that they will occur. This principle is called the conservative principle. Number two, stay with an accounting method until a demonstrably better method comes along. Using different accounting methods will lead to inconsistencies. This principle is called the consistency principle. Number three, transactions of a business should be kept separate from its owners and other businesses. This is called the economic entity principle. Number four, include in or alongside the financial statements of a business all of the information that may impact a reader's understanding of those statements. This is called the full disclosure principle. Number five, the concept that a business will remain in operation for the foreseeable future. This is a concept that the accountants use to work. That a business will remain in operation for a foreseeable future. This is called the going concern principle. Number six, a business should only record transactions that can be stated in terms of a unit of currency. This is called the monetary unit principle. Number seven, only those transactions that can be proven should be recorded. This is called the reliability principle. Number eight, a business should report the results of its operations over a standard period of time. For example, 1 month, 6 months, 1 year, and so on. This is useful for trend analysis. This is called the time period principle. Number nine, the amounts in your accounting system should be quantified or measured by using historical cost. If you bought a piece of property for 9 million naira last year, in your accounting record it should still read 9 million naira this year. That's basically what this accounting principle means. You shouldn't add if it has increased in value or reduced in value, you shouldn't use you should use historical cost. Number 10, accounting measurements and accounting reports should use objective, factual, and verifiable data. You shouldn't assume the data. You should use verifiable data. This is called the objectivity principle. Number 11, only recognize revenue when the business has substantially completed the earnings process. Substantially completed the earnings process. This is called the revenue recognition principle. Number 12, an expense occurs at the time at which the business accepts goods or services from another entity. Once you've accepted the goods, in accounting, you have incurred the cost. So this is called the expense recognition principle. Number 13, accounting transactions should be recorded as they occur. This is called the accrual principle. And finally, number 14, match each item of revenue with an item of expense. This is called the matching principle. So why learn these principles? By learning and gaining understanding of these accounting principles and adhering to them, you'll be able to communicate more effectively with an accountant or bookkeeper you hire throughout your business lifetime. Now, do you see the reason? You'll be able to communicate more effectively with an accountant or bookkeeper you hire throughout your business lifetime. So, as an entrepreneur, entrepreneurs don't only work hard, they work smart. You should hire an accountant to help you with your accounts, to help you to keep proper accounting, so that you can focus on getting more customers rather than having the headache of trying to balance your accounts. So a good accounting record, a good accounting record keeper. Now let's talk about record keeping. A good accounting record keeper must ensure that every transaction is recorded. Now, as the entrepreneur, the business owner, you should ensure that every accounting record, every transaction is recorded. Someone, your sales team, they make sales, they should record the sales. If there's an expense, they should record the expense. Every transaction has to be recorded. This is the first general rule of accounting. A good accounting record keeper must also ensure that transactions are recorded using what is called a double entry accounting method. So if you hire an accountant and you observe that he's not adhering to this principle, you can ask why. Is it that you hired an incompetent accountant or an incompetent bookkeeper? So your understanding of these principles would even help you to guide whoever you're going to work with better. So this is called the second general rule of accounting. Record keeping. Accounting record keeping is based on two basic principles. 1. Every debit must have an equal credit. 2. All accounts must balance. I learned this principle firsthand when I worked in the bank and when I became the cash officer of a particular branch. Every account must balance. If not, you are not going home. Every account must balance. So in your business, you should adhere to this principle. Every account must balance. So record keeping, a chronological record of all transactions is kept in a journal used to track all bookkeeping entries. Now, for those who may not have accounting background, let us quickly go through some of the basic definitions and basic terms in accounting. A journal. What is a journal? This is a book where all financial transactions are recorded for the first time. This is called a subsidiary book. What is a ledger? This is an account or record used to store bookkeeping entries for balance sheet and income statement transactions. This is called a principal book. A trial balance. This is a bookkeeping worksheet in which the balance of all ledgers are compiled into debit and credit account column totals that are equal. Don't bother yourself too much about these terms. Your accountant will take care of them, but just have an idea of it. So finally, another reason why you should learn these principles: to understand the value of an accountant in your business, and so that you wouldn't need to get into any argument with them when they insist on following these principles when preparing your financial statements, because you know that it is to ensure that there's never a question about the integrity of your business's financial statements. Remember that we said that accounting, remember what we said about accounting, the definition of accounting. You need to ensure that when the auditors come to check your books, that they would not pick out any inconsistencies or any irregularities. And that's why you need a professional to help you with your accounting. Because the principles of accounting are the general rules and guidelines. They are guidelines that companies are required to follow when reporting all accounts and financial data. Companies are required. The word required. They are required. So get a professional accountant to help you with your books, but have a basic understanding of how it works and how they work.